Good afternoon, everyone, and welcome to our new installment of the webinar series for the ASEAN markets. We are waiting for a few minutes for people to join in. Please bear with us. Thank you. So good afternoon, everyone. Good morning for those who are joining us from other regions. Today, we have a special session on how to make green projects bankable. We are still waiting for one more panelist who hopefully will join us first. But first of all, I will introduce Sajal Kishore from Fitch Ratings. And we will be waiting for Anuj Awasti from CGIF. Before I ask Sajal to give us an introduction about his background and his firm, I would like to explain to you a little bit about the background of this session. So far, in all our webinar sessions, we've been focusing on the definition of green bonds and green projects from various angles. But what is very important to understand is that the growth of the green bond market, which has been really surprising and has reached almost $1 trillion globally, which represent about 1% of the total debt outstanding in the world. This growth is really possible because green bonds are, first of all, bonds. And this is a special kind of security that is well understood by many investors around the world. Who put capital to work into those securities to earn a steady income. So the fact that these bonds are really very commonly invested by many types of investors make these green bonds such a good instrument to align projects with climate-aligned goals since the Paris Agreement in 2015 to limit global warming against pre-industrial levels. So what we really want to do today is to understand better what bonds are, how they are issued by different types of issuers. And that's why we have asked some experts in this field to join us to understand how a rating agency considers the issuance of bonds by corporates or financial institutions or sometimes sovereigns as well, and also a guarantor, which is an institution that also can support the issuance of bonds. So while we still wait for CGIF representative to join us, I will first of all turn to Sajal Kishore from Fitch Ratings. First of all, to tell us a little bit more about Fitch Ratings, what it stands for and the role it plays in the bond market, and also his background and his experience in looking at bonds. Please, Sajal, and please don't hesitate to keep it basic as well, because we have some people in the audience that are sometimes not that familiar with the bond markets.
Sure. Well, I can then speak for hours then. Thanks for that, Cedric. Happy to be here. So good afternoon to you all. So yeah, Fitch Ratings is one of the three leading credit rating agencies globally. So we have been in Asia for a long time, and we have a fairly deep presence in the Asian market as well. So we are in over 12 countries, and we obviously have a presence in local markets where we do local rating issuances. We rate, bonds which are in the local currency, as well as we are a global agency, so we rate international US dollar bond issuances as well. And our presence, we have sort of I guess, headquartered in London and New York, and we are present in all the product classes as well. And we have a fairly strong presence in the Asian market now. We recently also won a license to start domestic issuances ratings in China as well. So under a new affiliate company of Fitch Group, which is Fitch BOA Ratings. So within that, we will be rating onshore bonds in China for the financial institution sector to start with. So that's Fitch for you. In terms of my background,
Sajal, just before you start on your background, actually,
sure.
you said you are one of the 3 rating agencies. I think you refer to the international
S&P and
rating
Moody's.
agencies.
Yeah, that's right.
But in each country, there are also some domestic rating agencies. So
Correct.
Can you please tell us
Yeah.
what role you play for global investors in
Sure.
giving a rating that is, I guess, consistent across geographies?
Yeah. So the international ratings we do, obviously we have our international criteria that looks at our ratings, but equally we do have regional criteria to represent some uniqueness of different regions. So we rate the US dollar bonds issued by various companies or entities or sovereigns or financial institutions. And within Fitch Ratings, as I said, there are the 3 leading credit rating agencies are S&P, Moody's, and Fitch. But equally, you do have local ratings as well, which are in their respective countries. And as I mentioned, that we also have the capability to do local currency ratings, local currency bond ratings. For instance, we have had a presence in Indonesia for 14, 15 years now, where we do rate Indonesia bonds. We similarly, we have a local presence in Sri Lanka, we have in India, in Thailand, in Korea, and a lot of countries where we do local currency ratings over and above the international US dollar bonds that we rate globally as well. In terms of our different product groups within Fitch, so we obviously have the sovereigns, which we rate the different sovereigns in Asia Pacific and globally. We have financial institutions, which looks at the bank ratings, for example. Then we have the non-bank financial institutions. We'll look at non-banking financial companies. We have insurance group. We have a structured finance group, which looks at RMBS or ABS, those sorts of transactions. Then we have corporate finance group, which looks at non-financial corporates, essentially, and that is spread across various sectors. And then there's my group, which is infrastructure and project finance, which essentially looks at pure infrastructure companies, be it in transportation sector or energy, renewables, PPPs, which could be across water, energy from waste, or social infrastructure as well.
And you define infrastructure as the type of assets that is being financed, or the company that is behind the type of the asset?
So it depends. So the group, that's why it's called infrastructure and project finance. So project finance is obviously the structuring of the debt, which essentially isolates, you sort of rate the cash flows that come out of that particular asset. The reason why I'm sort of giving a broader answer here is a lot of infrastructure company or the assets are actually structured like companies. To give an example, airports, toll roads, seaports is a good example where they are companies, and they have their assets are actually infrastructure assets, but they're essentially run and operated like companies. But in some markets, these assets could also be structured. So you could have a transaction which is structured on a particular asset rather than the company. So you could raise a debt at the asset level, or you could raise the debt at the company level, and we do both. And that can happen even for these transportation credits. To again give an example, in the Indonesian market, each of the toll road concession is housed in a separate entity. So this job purpose is for regulatory purposes is only to house one particular concession. So we can rate that concession, or we could rate the company as well. So these are the sort of broader product groups. In terms of my background, I have been with Fitch now for 13 years, but my previous role, I've worked for banks like ANZ and HSBC, both in India and Australian market. I've sort of started my career in India, but moved to Australia, and I was in Australia for about 15, 16 years before I now moved to Singapore. In my previous role with Fitch in Australia, I was covering South and Southeast Asian energy and utilities portfolio. And within that, I sort of mean, the diversified utilities in the power sector, as well as oil and gas companies, energy companies. And in the current role, as I sort of already highlighted, it's a much broader set of issuers, which is not just the energy side of it, which is common to what my previous role was, but now I am also looking at the transportation and social infrastructure as well.
Thank you, Sajal. So I see Anuj has joined us from CGIF. Thank you very much for being here.
So for joining late because I had
no problem at all. So likewise, we would like to ask you for a short presentation of CGIF first of all, and also your background, please.
Sure. So just to give you a brief about CGIF, CGIF was set up under the Asian Bond Market Initiative, which is being driven by ASEAN +3 under the auspices of ADB. ADB is the coordinating agency for that. And we've been set up as a trust fund under ADB. And in terms of how we've been set up is that the ASEAN +3 governments have actually contributed capital and today we have about $1.07 billion of capital being contributed. China, Japan are roughly equal contributors, about 350 million each. ADB is the next, and the Republic of Korea are the next two largest ones. ADB is close to about 180 million, and Korea is about 130 to 140 million. I'm not sure the exact figure. And the rest comes from the other ASEAN countries. We are a single product organization wherein our prime objective is to develop the local currency bond markets in the ASEAN region. When we say ASEAN, we also add the +3 to it because China, Japan, Korea are also a part of this initiative. So what we do is we guarantee bond issuances in local currencies in the across the region. Keeping that in mind, given our financial strength and the amount of capital we have, plus I think also factoring in our parentage of sorts, we have a rating of AA from S&P, which typically morphs into a AAA rating for all the countries we operate in, except Singapore, because Singapore is rated AAA. So implicitly our bonds which we guarantee in Singapore and Sing dollars tend to be rated AA at best. But if you look at the other ASEAN region, wherever we go, we should be able to get a AAA rating in the local currency we operate in. We cannot do any of the hard currency guarantees. So when we guarantee bonds, one of the main, I would say, objectives for us to meet is to ensure that the bonds are issued in the currency, local currency. We have been working very actively across ASEAN. And if you look at the ASEAN countries, except for, I would say, Brunei, we've managed to get issuers from Brunei. We've actually got issuers from all the other countries in the ASEAN region. So we've done a deal for even issuer for Laos, who issued in Singapore. This was one of the first few deals we've done. Recently, even under COVID, we've managed to put through 2 deals in local currency in the Cambodian market in Khmer Rial. We've been very active in Vietnam. That's one market where we've done close to 10 guarantees, and we've been pretty instrumental in growth of the corporate bond market along with other participants in this space. We've also been active in Thailand and Singapore. So when we look at local currency issuances, we are also working towards integration of the financial markets across the region. What I mean by that is we are actively supporting opportunities for, say, issuer in one country to issue in another ASEAN market. And that's important because if you look at the aspirations of the local governments, like Thailand wants to become a market where issuers from the greater Mekong Delta region, so Laos, Cambodia, Myanmar, they want them to come and issue. We've got queries from issuers from Vietnam to come and issue in the Thai market. Similarly, Singapore is a market which we think is very good because in terms of the debt capital markets, the evolution of the market is pretty advanced. So from that point of view, any company which wants size and tenor, we're able to get that in Singapore and Thailand. So this is what we do. From the point of view of what we're looking for in the future, obviously, we look at first-time issuers. We are very keen to support first-time issuers who want to issue in the market. We are looking at companies which are looking to extend tenor, because with our guarantee, the credit profile of the company improves quite substantially. So if a company is able to access, say, 1 to 3 year money from the capital markets on its own, and they can justify requirements for 7-10 years, typically applicable for project finance and even green bonds. We are stepping in can be a very good catalyst for that issuance to be acceptable in the market. We also have implemented what we call a developmental impact scorecard, where we rate each issuance and each bond from the point of view of how much developmental impact it will have in the market. And as recently as this year, it's been approved, where we've added anything to do with ESG and green to be a positive. We add extra points to those issuances because those are themes which we want to build on. Through our discussions, so issuance is one side, but also one of the biggest areas where we've been focusing over the last 4-5 years has been to get new investors into the ASEAN local currency markets. So just to take the case of Vietnam, it was a market where typically the large insurance companies, especially from the MNC vintage, were not very keenly investing in corporate bonds issued in Vietnam dong. But with our guarantees, the acceptability has gone up quite substantially. And we've seen investors from Japan directly investing in some of our issuances in IDR and Thai baht. So that's the kind of integration we want to bring about, where not only do we want to get a new set of issuers coming in, we also want new investors to find acceptability of bonds issued in local currency in the region. It's a wide mandate from the point of view that for a single product agency, it's actually quite a wide mandate. Unfortunately, we cannot do loans, we can only do bonds. And that's why we work very closely with rating agencies in each of the jurisdictions.
Well, what about the types of sectors that you're mostly focusing on? I think initially you had a mandate to mostly look at infrastructure sectors, but most recently you've done some microfinance deals, for example. So is that something that is shifting a little bit in terms of your focus?
I don't think so to answer that question, Cedric, infrastructure is always a focus for us, because I think if you look at the large monies being spent in the markets in ASEAN, especially if you look at countries like, say, Indonesia, Vietnam, even Cambodia for that matter, a lot of money is being spent, a lot of infrastructure development needs to take place. So we have to always be there. Yes, the last deal which we've done has been for Prasak, which is a microfinance company in Cambodia. But that said, in December, we've done a deal for Hong Kong One, which was an infrastructure, a solar power plant project in Vietnam. So it's not that we are focusing on one more. And if I look at my pipeline today, it's actually quite well spread out across each sector. We are largely sector agnostic, but we actually are a bit careful of going into greenfield risk at this point in time. We are more comfortable taking refinancing of projects which are up and running. I think that's a theme which will develop going forward, given COVID and the need for banks to release capital, where they might need to offload some long-term assets which they have. That's where an institution like CGIF could be able to take these companies to the project bond market, or do an infrastructure corporate bond for that matter. So infrastructure is a focus for us. So I can tell you today, if you ask me, we are very keen to do more on the green side. And we have been focusing a lot on solar and wind in particular out of this region. And we've been getting a lot of inquiries from a lot of developers and a lot of project companies which do want other refinancing options because they want to free up bank lines for other new projects which they are investing in. So markets like Vietnam, Indonesia, even Cambodia, we've got a lot of queries on this side.
And Anuj, why is it that an issuer needs to get a guarantee from CGIF? What makes it difficult for them to access the market? Is it because they are not known and therefore they need to reassure investors? Or is it the learning curve of accessing the markets? Or is it a mismatch, like you said, between the tenors they're looking for or the currency? What is it?
I think the main problem in Southeast Asia is the rating and the rating cliff. So if you look at a lot of the jurisdiction we work in, especially let's take, for example, say Cambodia or even Vietnam, they are all below investment grade. So when we look at global investors, when they look at the companies from here, they are very excited when a name like CGIF gives a boost from sub-investment grade to above investment grade. And that makes it meet their credit matrices much easier. So from that point of view, that's a very big draw which we are able to provide, because essentially the way we structure our guarantees, it's a unconditional, irrevocable, on-demand, a non-payment event guarantee. So if there's a non-payment event which happens on the bond, CGIF pays for it, and then we take care of whatever we have with the issuer. We retain the right to accelerate or not accelerate. So that also works well for the investors. So that's the credit upgrade which we give. The second thing which we think is extremely important for global investors in the bond markets is that we are very tightly bound. So because we're a trust fund of ADB, we have to follow all the ESG standards and the safeguard standards of ADB, which is a very big plus when it comes to global investors, because I think more often than not, especially the MNC investors or the local or the people who are investing from overseas are following green standards or are being very particular about safeguards and ESG standards. And given the fact that we adopt ADB standards and we've given our tick, it is easier for them to get their approval, especially in markets where these standards are not so developed. The other thing is, like Cedric pointed out, a lot of the issuers we support are first-time issuers in the bond market. We've had cases where after receiving our support, companies have been able to go on their own, which we think is very encouraging. I can name a few, like Astra Sadaya Finance, a big multi-finance company out of Indonesia. They did a $100 million Sing dollar bond with us in 2014. And within a month after that, they were able to do $300 million on their own in the USD bond markets. Masan, the first bond they did under consumer vertical, was actually supported by CGIF, but after which they've become a regular issuer in Vietnam to all the other investors. So I think the first time issuer tag is what we actually introduce them to the market, get them familiar with the investors. And once the investors get the comfort that everything works well and the guarantee has not been called upon, they're able to do this on a standalone basis with the same issuers. So these are things which are pretty attractive from our point of view.
Thank you, Anuj. And Sajal, can I ask you this question about the sovereign rating? How is it important for an issuer to be able to access global investors if you are in a country that has a credit rating that is relatively low, you know, like, let's say, for example, Cambodia, in the example of Anuj? How does that factor in the analysis that you're doing as a provider of credit rating?
Yeah, so I think I would say almost all the bonds that are issued from any particular country, unless there are structural enhancements or you are trapping US dollar cash flows outside the country, so you're kind of preventing any transfer and convertibility risk that we assess in these transactions from sort of meeting your US dollar obligations on the loan, on the bond, from your local currency denominated cash flows. So that's the reason why a lot of the all the transactions are capped or constrained by the sovereign risk. I wouldn't say the sovereign rating, but what we call is a country ceiling. The country ceiling is slightly different from sovereign rating because the country ceiling also captures the transfer and convertibility risk, which I just explained. But usually in these markets, the country ceiling and the sovereign rating are almost the same. So you can say that the sovereign rating kind of caps the rating. And also it reflects the fact that all the assets are largely in that particular country. The laws, everything there, sort of governs the cash flows or governs the ability of the issuer to manage those assets or cash flows in that particular country. That's the reason why the ratings are constrained or capped at that level. So to that extent, to what Anuj said, in these economies which have sub-investment grade ratings, the ratings are reflective of that. But but it really depends on the asset as well. Like, for example, just a year and a half ago, we did the first project bond out of Vietnam, which was a power company, Mong Dong 2, which is an AES owned entity in Vietnam. Fairly sizable transaction, almost 700 million US dollar, out of a total refi of 1.1 billion. The balance was a bank loan, which was refinanced. But the bond, which was around 700 million, was oversubscribed, I think maybe 3 or 3.5 times. So there was a lot of interest, and the rating was a double B on the bond. So you can get investors in the international bond market, even with a sub-investment grade. And Vietnam is a very good example of that. I think there's a lot of positive story around Vietnam, which is sort of helping Vietnam, and that's why we've seen that issuance out of Vietnam.
So if you are a project owner in, let's say, Vietnam or one of the ASEAN countries, which has a relatively low sovereign rating, what can you do structurally to your project to strengthen the credit worthiness of that project? You mentioned a few things about securing cash flows and ensuring convertibility. What structurally can you do on a project?
Yeah, those are very rare examples, and the good case in point comes to mind is when PNG, Papua New Guinea, was setting up its LNG facilities going back many years now. And it was an ExxonMobil owned facility in Papua New Guinea is a B category, B rated sovereign, whereas ExxonMobil was a AAA rated entity. The issue was, how do you pierce the country ceiling, and how do you get a rating on that facility which is higher than the B rating? And I think you need to sort of, as I said, if you are able to, for the US investors, overseas investors, if you're able to trap US dollar cash flows. I mean, in this case, they were US dollar cash flows because LNG is sold typically to the North Asian utilities in Japan, Taiwan, and South Korea. And so you get US dollar cash flows. If you're able to trap that overseas, you can pierce it. And so there are ways of structuring it. Equally, I think there have been some transactions in the European market, especially in markets like Turkey, where they have been able to get some liquidity support from EBRD, for example, which has allowed the transaction to pierce the country ceiling and be rated above it. So it's really about giving the investors comfort that they will have the first right on the cash flows, and the cash flows are outside the country. So the country's foreign exchange rules and laws will not prevent them getting hands on the cash flows, on the US dollar repayments.
What importance do you give to a guarantee from, for example, a CGIF, which is rated AA by S&P? Would you consider that is a substitution of rating in that case? How would that work?
Yeah, I think we don't rely on other agency ratings when we sort of do our own, but we would do our own analysis. We have done pure guaranteed rated transactions, and in those instances, we have applied the guarantor's rating because it's a credit substitution. So the principle of credit substitution is there, as long as the guarantee is full and irrevocable, etc. So I think what we do see, other than the structure that Anuj talked about, we do see what we have called as a partial credit guarantee that is prevalent in some markets, like India, for example, and that provides probably more of a liquidity support. It boosts your recovery prospects rather than reduces your probability of default. And I think that's where the differentiation comes in. And in those instances, the rating gets enhanced for the recovery prospects, but it doesn't substitute for the rating of the PCG provider. And PCG providers in those instances is companies, is institutions like MDBs like IFC, etc., which are very strongly rated.
And PCG is partial credit guarantee. Right?
Yeah, it is partial credit guarantee. It's also quite common in Latin America as well. It's again used in developing countries, local currency financing primarily. I haven't seen that many in other. I think there's maybe a couple in Indonesia, but I haven't really seen that many yet.
Anuj, on the guarantee that you're giving, it's not always 100% guarantee, right? In some instances, it's partial. How do you come to this decision as to whether to give a full or a partial guarantee?
I think it's a function of the market, Cedric. We basically, so if you look at markets like Cambodia, and we are very mindful of what the investors want. So if I go to a developed market like say Singapore and Thailand, and in these markets, typically with the bond markets, even Malaysia for that matter, where the bond market is substantially developed and you have a whole set of wide set of investors and issuers, what typically happens is that a lot of companies are just below the cusp of reaching a A rating or an A- rating when pension funds or the large state-owned funds are willing to invest in them. So if there's a company which is say triple B minus or a triple B kind of a rated company and wants to reach that A threshold, we've been able to provide partial guarantees there to get them over that, because for them, they do not have the added benefit of getting the AAA from us. So for the company also, it is better if we have a partial guarantee because the fee would be less for them, as well as the investors are happy because we've made them go over the rating cliff. So it meets both our objectives. But what we've seen more often than not is that in countries like Vietnam, even Indonesia, as of now, the deals we're working on, or Cambodia, Laos, Myanmar, the deals from these jurisdictions, we have to go with a full credit guarantee. So partial credit guarantees, definitely, we've done quite a few in Thailand. We know that it'll work in Malaysia and Singapore, but I think for issuers outside this jurisdiction, we probably have to look at full guarantees at this stage.
And Sajal, Anuj was mentioning that CGIF is interested in developing the local currency market. Now, Fitch, for example, you said in Indonesia, you have a long presence already of more than 10 years. Yeah. But yourself, you are mostly focusing on the external debt of the issuers. Is there a big difference between local currency issuance and foreign currency issuance? For example, I don't know, if I'm in a group, maybe in Indonesia, and I issue locally, I probably get a pretty good local rating. But if I go overseas, I may get penalized. We spoke about the sovereign ceiling, but there may be some other factors as well. Can you give us a little bit more of color on that?
Sure. Yeah, look, so my team does both local and international ratings. So as I said, I have people in Indonesia who do Indonesian ratings. They do ratings both in Indonesian rupiah as well as US dollar by Indonesian companies. So the rating process is the same. The rigor, the approach, everything is the same. In the sense we do the same set of analysis. It's the same criteria, which looks at the assets, the cash flows, etc. Obviously, there's an overlay of a national rating vis-a-vis the international rating. The difference is the national ratings are typically an ordinal ranking of ratings. So it's not a PD rating. It's a rating of ranking within similar rated entities in that geography or jurisdiction. So you start with the strongest and then you go down to the weakest. So that's what a national long-term ratings are. Whereas the international ratings are, probability of default ratings, which have the variations are hence can be quite different. So we use what we call as correspondence tables to sort of map from the strongest credit in that particular jurisdiction. It could be the sovereign, or it mostly is the sovereign, but it sometimes could be some entity stronger than that. And then you sort of rank down, and then you rank down your different entities within that country. So as I said, yeah, the process is really the same. And so an issuer, and that's the advantage for us where we have a local presence, because the regulations, do stipulate that, if you are to rate the local currency rating, you need to have a presence and in the local geography, and you need to have an office there. And that's our advantage because we are the only international agency to be in Indonesia, and the Indonesian local currency market is reasonably robust, and a lot of the, especially the infrastructure issuers, the ones have local currency cash flows, it makes sense for them to issue local currency bonds. As well as, I think Bank of Indonesia regulations also stipulate that they need to have ratings as well. So I think from both perspectives, our ratings help.
And the local rating is used by whom? Is it local investors?
By
mostly?
local investors, yeah, local investors, or in the case of Bank of Indonesia, they also use it for the regulatory reasons as well. But yeah, local investors typically.
Okay. Now, when we look at the green bond market, we see a dominance of bonds issued in the energy sector, renewable energy, in the buildings, and in transportation as well. Can I ask you both, maybe starting with Anuj, why are those sectors so dominant? Is it because they fit well within the context of bond issuance, maybe compared to some other more volatile sector?
I think these sectors do fit very well with the green bond criteria. So that's one thing. And the other thing is that we are seeing a lot of investors who want to park money in these areas. Like I can tell you a lot of banks have stopped funding coal or anything to do with petroleum in the region. So when it comes to long-term investments in infrastructure, they are naturally gravitating towards things typically on the green side, like wind, solar, or even geothermal, which we've seen doing pretty well. Hydro has done very well in this space. So that is a natural bias. Transportation, yes, there's been one deal which has happened in the whole region, but I really don't think it's picked on beyond that deal in Thailand. So there's a lot more which can be done in that space. The space which a lot more can be done on the bond side is more on the social side, because we really haven't seen too many social bonds coming out. That is something which we think we are keen to work on. But if you ask me, the reason why a lot of green work has been done in the renewable energy space is because you have a lot of that happening in the region. You go from each country you visit, the amount of work going on the renewable energy space is amazing. And solar being one, wind is just starting to pick up in a lot of countries. So this is the theme for the next 4 or 5 years at least, we think. And even when the COVID situation is on or anything, I think this is one sector which we are getting regular queries from across the board. So we think over the next 2-3 years at least, we have enough to do in this space. And it's actually a low-hanging fruit, if you ask me. If you have to do something on the green side, then it's actually quite a low-hanging fruit to pick up and start working on.
Sajal, I guess you agree with that, but also what makes an energy project an investment that can easily be financed with a bond or a green bond?
Yeah, so I think that's right. So energy projects, so obviously you have your traditional fossil fuel fired power plants, and then you have your renewables, pure play renewables. So for both, I think the starting off point is really you're looking at the asset and you're looking at the power purchase agreement. I think that's really the key from a rating perspective, to make sure that those PPAs, as we call them, is investable, bankable, and it has all the protections that the plants require to get a rating, or to have a cash flow stability to get the required rating. And it depends also on the sponsor's end goal as well. As I said, some sponsors want to target only investment grade ratings, and some sponsors want to target a sub-investment grade rating, and accordingly, they may have different levels of debt on the asset. So your cash flows are your cash flows, but you can put as much debt on it to get a financial profile commensurate with the rating level that you want to achieve. And there are other motivations as well. In EU, you may want a longer duration. So you could go for a project bond, fully amortizing bond, which we've seen now in the case of some coal-fired plants out of Indonesia and Vietnam, the one that I mentioned. But renewables is one where we rate a lot of renewables in Asia, and we rate globally as well. But Asia is clearly a huge market, huge growth market in renewables, pure play renewables. India has been a long issuer in renewables for a very long time now, for 5-7 years. Even in my previous role, I was involved with a lot of the Indian renewable issuances. But we are seeing now a portfolio of renewables being issued or being considered out of China, Australia, and increasingly, we are now seeing even pure merchant transactions come out of renewables, which was unheard of even a couple of years ago, because getting a merchant transaction out with a strong rating is quite difficult.
And what about the technologies themselves? Do you feel that within the renewable energy space, all technologies are equally bankable, or there are some differences?
Yeah, look, technology risk is not there in renewables that much. Most of the technologies become quite standard. Operations risk for renewables is largely less. I mean, I would caveat that out for different fuels. So obviously, solar is the one which is quite standardized, commoditized. Wind, there are some complexities in different mass sizes, etc. Sponsors try out different things, and that could add some layer of complexity. But even wind, by and large, is relatively easier to operate, and technology is proven. But we are seeing a lot of offshore wind now in Asia. We did see a lot of offshore wind going back 3-4 years in Europe, and initial offshore wind projects had a lot of challenges. But over time, even they have become people have got comfortable with the technology there, and that's why you are seeing a huge growth in offshore wind, especially in markets like Taiwan, which is leading the forefront of that at the moment. But then you move into other technologies like geothermal, which is a strong fuel, but it requires a lot of drilling of wells and make up wells, etc. So there's a lot of ongoing capex is required to continue to prove the reserves. So the resource risk is there with geothermal, but then once it flows, it's quite strong and steady. It's not an intermittent resource like wind or solar, and it can provide good base load. So I think there are different fuels have different types of risk. Coal, obviously, again, technology is largely standard. There were some issues around equipment suppliers from certain markets which were not up to certain quality, but over time, even that we've got comfortable around that. So the operations risk varies on different fuels. Technology is by and large now stable. The costs have been coming down in renewables, which is helping renewables growth quite substantially. And as a result, you've seen a lot of the governments take away a lot of the subsidies they were giving to renewables because they're no longer required. They are grid parity in most countries now. Yeah.
And are you sensitive to at what time of the life of the project the bond is issued? For example, if it's a project that still doesn't exist, it hasn't come out of the ground, does that make a difference compared to a project that is up and running?
Yeah, so I think by and large, the traditional route has always been that in the greenfield space, banks are the ones who are closest to the project. They can monitor it, they can do progress drawdowns, etc. So there's no negative carry. You stick to the banks, you do your greenfield. Once the project is de-risked, gets into the operation phase, you do a long-term, long-dated, fully amortizing bond, and through the capital markets. That's the traditional route in a more developed market. Obviously, you have variations in different markets. We don't see too many greenfields. We don't see any. I mean, at the moment, getting a coal-fired greenfield is near impossible. It's not really happening in these markets unless it's in a big utility, in a house within multiple projects within a utility. Then that's a different case because there it's being funded on the corporate balance sheet. But In renewables, you do have some element of construction risk or completion risk in it. But as I said, these projects are largely standard now. Solar is, plus they're only 2 years at best in terms of their construction time frame. So there's not much of a risk there. But the ratings that we normally do are largely pools of operating assets. They may have very limited operating history, but they are largely operating assets. They may have a few construction projects in it, which are just 6 months left for commissioning, for example. So we can rate those. That's not a problem. In the transportation space, we have done some roads, which are in the Australian market, where roads are under construction or under development. That's had some greenfield. That's had greenfield in it. But by and large, it's largely been operational. And we do a lot of brownfields. So, like we rate a lot of airports or seaports, and they are always expanding in this market. I mean, especially going before COVID, airports was on a huge growth phase in Asia, huge growth phase. So each and every airport in every country in Asia was on a expansion mode. So we were doing a lot of brownfield expansions.
Now, you mentioned the power purchase agreement, or PPA, as a very critical element of a project. What would you say makes a good PPA versus a not so good PPA?
Yeah. So yeah, look, I think it really comes down to a couple of things. It's really about getting stability of cash flows. Because ratings are higher ratings are driven by as long as there is visibility over cash flows and the cash flows are stable. If those two things hold, either structurally, contractually, or whichever way, you can get to that, you get a higher rating. So the PPA helps in that sense. If you have a longer dated PPA, that helps. You have a PPA with fixed price, so you don't have a price risk. If a PPA which doesn't have any volume risk, so if you have a take or pay or take and pay kind of an arrangement, those things help in terms of the PPA. They are well defined, termination provisions, which sort of allows the recovery of your debt if there was a default or termination event. There is well defined dispute resolution mechanisms in the PPA. There is ability to match or meet your FX risks. There's ability to even consider changes in law. I think one of the things we look at for especially for coal-fired plants now is that whether they are what happens if tomorrow there is a carbon price, for example, which comes into that country, whether the PPA allows for those additional costs to be passed through to the off-taker or not. I think so we look at that as well. And then you look at curtailment risk is again a huge issue, whether the off-taker, the grid is stable or not, whether they can curtail it for grid stabilization issues or without any compensation, whether there's compensation associated with it or not. So I think these are the key things. And in the countries that we sort of we've rated, and we rate in Indonesia, Vietnam, and India, in these markets in sort of coal-fired plants or renewables, we find that the PPAs there generally work. There are some markets and some types of fuel, like for example, Vietnam renewable PPA for us is still not there yet in terms of investability point of view, whereas the PPAs for renewables that are there in India generally work. India, the issue is more about the off-taker credit quality. So that's another issue you have. What is the off-taker's credit quality? Because ultimately all the cash flow is coming from an off-taker. Now, if your off-taker's credit quality is quite weak, that has a constraint on the rating as well.
And the currency of denomination of the PPA is a strong factor as well, right?
That's right. Yeah. So whether you sort of retain the currency risk and whether you're able to hedge that or not. Like for example, in the Indian market, getting hedges out beyond 5 years gets very expensive, prohibitive. So if you have a 20-year debt facility, then after 5 years, you're basically doing a rolling hedge, and that is not really as strong protection as a fully hedged facility, for example. So again, it depends on what kind of debt structure you put in on these transactions. If you have a fully amortizing bond, for us, that's a much stronger debt structure, and that helps the rating as well, because there is no refinancing risk in those structures.
Thank you, Sajal. Anuj, from CGIS point of view, how does that work in practice? Is it the issuer that comes to CGIF to request a credit guarantee, or is it their banker? I know on your website you have a form that it's possible to fill out and send to you to ask for initial feedback. Can you please tell us in practice how that happens, how long it takes, cost-wise, and so on? We cannot hear you, Anuj.
Can you hear me now?
Yes, it's better. Thank you.
Okay, sorry. I'm having some connectivity issues at home, so just do pardon me for that. So basically, so we are pretty open architecture from that point of view. There are certain cases where the queries have come to us directly, and there are certain cases which have been brought to us by the bankers. So we are open to dealing in both ways. But if you look at the practical aspects of how bonds are to be placed, we are not licensed to run the debt capital market process across most of the jurisdictions we work. So we need a banker to run the process of doing the bond legwork, issuance legwork, like the documentation, the regulatory filings and all that they'll have to do. So from that point of view, as we are open to receiving from our website, and we are in regular contact with almost all the banks in the street. Given the fact that we've done close to 39 guarantees already, I think most of the banks know what we do and are regularly putting us in touch with their prospective clients or issuers who they feel make sense. I think the advantage we have today vis-a-vis 10 years back is that a lot of the market knows what we do, especially in ASEAN. So that way, a lot of the debt capital markets teams and even the relationship teams in the banks know that CGIF is an alternative, especially when it comes to long-term project financing. Like Sajal mentioned before, that the greenfield is taken care of by the banks, and if they need tenor extension beyond that, they ask us to come in. And we've been getting increased queries on that side over the last 6 months or so. So that's a big positive for our franchise. That said, how we go about it is that we, like any bank, because at the end of it, the way we structure our guarantee, we end up taking almost all the risk. So short of being a lender, we are the lender, because at the end of the day, the bondholders have a completely irrevocable unconditional guarantee from CGIF. And if any issue happens, we have to pay the bondholder and then go and recover the money from the issuer. So effectively, we have to run it through the entire process of credit. We have internal risk rating criteria, which we follow quite strictly. Besides that, we also view every project from a ESDD perspective, which is environment and social sustainability process. Like I mentioned before, that we mirror ADB's guidelines because we're a trust fund under ADB. So we mirror their guidelines, and ADB, the compliance teams in ADB act as our consultants also in that. They advise us. They don't take the decisions for us, but they do advise us on a lot of what we are doing there. We have our own teams doing it, which work very closely with the ADB teams. So that's another part of the process which we run quite closely. And if there are any remedial action which the issuer needs to take before we can support the issuance, we advise that. And we've seen a lot of cases where we've actually gone and drafted the environment, social, sustainable management systems for the companies also, because one is to do it before the issuance, but the second part is to ensure that there's continued compliance. So which is why the ESMS, as we call it, is extremely important for us to implement. So besides credit, we also take safeguards as an equally important parameter for us when we look at deals. In terms of timelines, how it works is that typically from a query coming to us, if we are very optimistic, we can get everything done in 3 to 4 months. But usually it takes about 6 months to put a bond through. Project bonds can take a bit longer because project bonds are a bit unique, especially if it's being done in local currency. We've seen it's easier to do a project bond in US dollars, but since we can't support it, local currency takes a longer time, because typically the people who are willing to do local currency and project bonds are the nascent issuers, the first time issuers. So getting them to understand all the bells and whistles which come along with the ring fencing, how the cash flows, how they have to shut the accounts down, how they have to manage everything, takes a bit more time. But yeah, from our point of view, all this is a part of our developmental mandate. So we have to do it. So we are doing it. And we are very happy to do it, to be very honest with you. So
Thank you,
actually,
Anush.
we think that to be a very, because we believe that if we educated one company to do a project bond in the right manner, it actually would spread across the market very fast.
Yeah, it's an important work you're doing.
Just coming back to one more point about you asking why renewable is doing well. I think it also comes from the perspective of insurers, the insurance companies which are growing in the ASEAN region. If you look at all the ASEAN countries right now, the investable surpluses in local currencies with the insurance companies are going up. And the products which they're offering are all seeking duration. So when they're seeking duration, we believe that that will lead to the development of longer term project bonds and infrastructure bonds. And green space is just right at smack in the middle of it. So we should be able to get a lot done over there because of this.
So Sajal, your team on local currency should be more busy than.
Yeah, local and international. I think so. Just on this last point, which Anuj mentioned in terms of project bonds, and I think that's a trend that we're seeing in this space where renewables were largely corporate bond issuers going back a few years, but we have now started to see more project bond type structures. I wouldn't say they are fully project bond, but they are near project bond. So we rated one issuance out of India, which was rated BBB minus, which was a 20-year facility, 75% amortizing. So almost project bond like, and it had a lot of the bells and whistles of a PF style bond that you would expect in terms of covenants and protections for investors. So I think we are beginning to see that trend in renewables as well. I think the issuer is always in Asia is always very price sensitive. So, it's there is a mismatch usually between whether they get an attractive 3-year money or 5-year money, or you go for a slightly more expensive 20-year money. But I think, slowly we are seeing companies looking at diversification as one aspect of going into the international bond markets or bond markets, the local bond markets as well, over and above just the sheer interest rate incentive.
So someone is asking in the chat box whether there is any example of a private company issuing a bond for Plantation Forestry project in Indonesia. I can think of one, TLFF, for example, which was one. I don't know if CGIF was involved.
No, we were not. In fact, TLFF was done by with an involvement of US aid, if I'm right, because US aid came and gave an enhancement to the structure by a partial guarantee. I think they guaranteed the senior piece in that. I don't think we were involved in that. And but we've had discussions with TLFF for another tranche, and I don't know how that will go, but that's very initial. So we have been getting some queries from plantation companies. TLFF was a unique structure, which was done by BNP, was the bank which structured it. And but after that, we really haven't seen any big plantation company. At least we're not aware of that.
Was Fitch involved in any such projects, or maybe?
Look, our plantation companies are sort of especially the palm oil ones are handled by my corporate colleagues. So I really am not aware of this transaction myself.
But Sajal, if I can stay with you for a minute, in terms of the extra financial parameters, obviously your focus is mostly on the financials, but Anuj mentioned that one reason why people come to CGIF is also the ADB style screening of non-financial parameters. How relevant is it for you at Fitch in terms of assessing the strategy from a social, from a green and sustainability angle for the issuer?
Yeah, look, I think it's probably a misconception that we only focus on financials. So our analysis is extremely detailed. So we look at ownership, sponsors, we look at management strategy, we look at the assets. As I said, depending on the type of the asset, we drill down into what is the essential contract which is driving the cash flows of those assets. We look at the technology risk, we look at operations risk. So our analysis is, project bond analysis is as detailed as a bank would do for a project bond facility. So we look at third-party opinions on, we get technical advisor reports on the the technology used, on the operational costs. We get resource consultants reports on resources and how the production forecasts are. We get price consultants to give us price forecasts. So we look at all that as well. So fairly detailed qualitative analysis. So each transaction will have 4 qualitative attribute which we assess. To give an example, for renewables, we would look at the operations risk, we would look at volume risk, price risk, and then we would look at the debt structure. And in the debt structure, we will look at from issuance structure to security package to the waterfall to all the protections, etc. in there. And then finally, once we've done all that, then we'll focus on the financial analysis, and that financial analysis, along with in conjunction with our qualitative assessment, then drives the rating, which we then sort of benchmark it against the peers to get to a final rating. So it's a fairly comprehensive, detailed work that we do. It takes 4 to 6 weeks of intense work to generate a rating. So it's fairly detailed. Obviously, the modeling aspect is also quite critical. And very, very detailed. And that's why, to a large extent, the models that we get for project bonds, etc., are developed by banks, and they work on it for months before they come to us. And usually in all our transactions, there are rating advisors involved in the process, because because of the complexity of the transaction and the complexity of the analysis.
And is your view changing on for example, if issuers that are pure play fossil fuel utilities or fossil fuel energy producer, in the context of the change in regulation, the change of asset mix? Are you changing your opinion?
Yeah, look, and I forgot to touch on ESG. So I think ESG is also a very important part of analysis. As a rating agency, we were one of the first ones to come out with an ESG, how we look at ESG within the context of our credit rating. We took each and every credit across all product groups globally, and that's like, thousands and thousands of ratings over a period of 6 months back in 2018, and we now produce ESG scores on each of our ratings. So basically, we were always looking at ESG as a part of our analysis. So governance is a key aspect of our rating approach. As I said, we look at ownership structures. We look at how boards are constructed, how various decisions are made in companies, and even if you look at group structures, how convoluted they are, and all those things we look at. We look at obviously we look at E aspects as well. We focus on environmental costs and legislations, etc. And then we focus on the social aspects as well. So ESG was always part of our analysis, but with our ESG scores, what we are doing now is for each and every credit that we have, each and every credit rating that we have, we do produce an ESG score, and that's reviewed and renewed every time we review and renew those credits. And our press releases actually have full details of those scores, and to an extent where we say that whether ESG factors are material to the rating, relevant to the sector, relevant to the credit, and as having a material impact on the rating, we highlight that very well. So to give you an example, we rate quite a few coal port terminals in Australia. So there are 3 big ones in Australia. We rate those, and they are basically network, right? So because they get the coal from the source mines, and they ship the coal to China and to other utilities in Asia. So their exposure really comes down to the debt structure that they have in place. So, and that's why I said debt structure plays quite an important role, because what we are finding is that investors are focusing a lot more on ESG now, and they are getting uncomfortable to lend funds to anything which is coal exposed. So to the extent that these issuers have a refinance risk, they are exposed. And we rate Adani Abbott Point Coal Terminal in Australia, which we put on rating watch negative this year because in March they were unable to refinance their March maturity, May maturity. So they had gone to the market in early March, just before COVID actually hit in Australia, and they were unsuccessful. And finally, the parent company had to step in and provide the funds. So but previously we've always highlighted this refinance risk for these issuers. So we have been highlighting this for various issuers, and equally, as I said, for the coal-fired plants where there is fully amortizing debt, there is no refinancing risk. So that risk is not there, that they will not be able to repay anything. But clearly, when we look at the PPA, we look at their ability to pass through any emissions related costs that would come in future. And that forms a very critical part of that.
Thank you very much, Sajal. It's very encouraging as we continue to promote thematic issuance of bonds, green and beyond that, social or sustainability bonds as well, which we believe would also protect investors in terms of the long-term challenges that our societies are facing. Unfortunately, we are already over time, and I would really like to thank you both for your generous time today. You have both busy schedules. We really value these discussions and this opportunity to share your experience. So thank you so much from CBI and from the rest of the audience as well. We thank you for your participation. Next week, we will have 2 other webinars, one on Vietnam and one on Indonesia. So please watch this space. We continue this series where we try to share the experience of the green bond market. Thank you very much for today, for joining and for your participation. And we hope to see you very soon in the future. Thank you.
Bye-bye. Thank you. Thank you. Thanks, Cedric.
Bye. Bye, Cedric.
Bye.
Bye.
Bye, Sajal.
Bye, Anuj.